Grade 10, Lesson 2, Part 1, Term 2, Forms of Ownership. In your Gauteng Department of Education, it's the notes for Chapter 9, and in your textbook, pages 69 to 77. What you will learn. You will learn to outline and name the factors that must be considered when choosing a form of ownership. Explain the differences between profit and non-profit organizations or companies. Outline the forms of ownership and classify them into profit and non-profit organizations. Define the meaning of different forms of ownership. Explain, discuss, describe the characteristics, advantages, and disadvantages of each form of ownership. Distinguish, tabulate, differentiate, and compare different forms of ownership. Identify forms of ownership from given case studies, scenarios, cartoons, or pictures. Outline different types of cooperatives. Explain, discuss, describe the advantages and disadvantages of cooperatives and select the best form of ownership and justify the reason for selection. So there are various factors that you need to consider before you choose a specific form of ownership when you start a business. First and foremost, you will have to look at the size and the nature of your business. What are you selling? What service are you providing? Then secondly, the way in which the business is controlled and managed. Do you want to manage the business on your own? Do you want the help of others? Do you want shareholders? Do you want directors, etc.? Then thirdly, who bears the risk? So if there's a financial difficulty or you might lose a lot of money, and then who will bear the risk? How will capital be raised? Will it be raised by yourself or will it be raised together with your partners, etc.? How will profits and losses be dealt with? How will you share the profit? Who is responsible for the debts? In other words, the liability of the company. What will the tax implications be for the specific form of ownership? What will the continuity be? In other words, the lifespan of the business. The vulnerability of the business in terms of lawsuits. In other words, is the business the legal person or are you the legal person? These are the factors to consider when choosing a form of ownership. We are now going to look at the difference between a profit and a non-profit companies. Profit companies aim to make a profit. That's the sole reason why they exist. Whereas non-profit companies, they do not exist to make a profit, but they were established for charity purposes, like orphanages, etc. Profit-making companies is a company incorporated for financial gain for its shareholders, whereas a non-profit company is an association incorporated not for gain, so they do not have shareholders. Profit-making company, the memorandum of incorporation sets out who the directors and shareholders will be, as well as their rights, their duties, and their responsibilities, whereas a non-profit company only states in the memorandum of incorporation what the purpose of the company is and its operations. In a profit-making company, it also sets out the number of shares that the company is authorized to issue, whereas in a non-profit-making company, the company have an independent legal entity, but the board of trustee is protected unless found negligent or fraudulent. We are now going to look at 3 forms of ownership in this lesson: the sole trader, partnership, and the CC. In the next lesson, we will be looking at all the other forms of ownerships. I have attached a video that is a revision from grade 8 with regards to the 5 forms of ownerships. For those students that did not understand it very well or properly in grade 9, you can go through that video again. So just to recap, there are 5 forms of ownerships: sole proprietor or sole trader, partnership, closed corporation or CC, and then the companies that consist of non-profit companies and profit companies. And then lastly, cooperatives. These are the 5 forms of ownerships that we will be discussing in this term. But for this lesson, I will only be focusing on sole proprietor, partnership, and closed corporation. Let us quickly look at the classification of forms of ownerships according to profit and non-profit companies. Profit companies consist of private companies that ends with Pty Ltd, a personal liability company, okay, and this is reflected as incorporated. Profit companies also consist of companies such as public companies, whose names end with limited or Ltd, and then also state-owned companies. And then a non-profit company is only reflected as NPC, which stands for non-profit company. So these are the classification of the profit companies and the non-profit companies. We will discuss the private company, the personal liability company, public companies, and state-owned companies in the next lesson. We are now going to start with the sole trader or the sole proprietor. We're going to look at the characteristics, the advantages, and the disadvantages of this form of ownership. First, we're going to look at the definition. A sole trader is a business that is owned and managed by one person. The business owner, that one person, handles everything, including the activities of the business, its processes, and its decisions. It is most suitable for a business such as a doctor, hairdresser, electrician, baker, etc. What are the characteristics of a sole trader or sole proprietor? The owner can sell the business to anyone at any time. There are no legal requirements regarding the name of the business. It is, in other words, you can use any business as long as it is not a business that is registered as another business. And you can use any logo as long as it is a logo that is not registered as a trademark with another company. It is very easy to establish as there are no legal formalities in forming this business. Sole traders are not compelled by law to audit their financial statements. The owner has unlimited liability. The owner is personally liable for the debt of the business. So it's not the business that's going to carry the financial risk, but the owner. The business has no legal personality and therefore has no continuity. And the continuity means that if the owner dies or cannot work anymore, then the business discontinues. Okay, so there's no continuity because if the owner goes, the business goes. The owner provides capital from his or her savings or borrow money from the bank. Profit is added to the rest of the owner's taxable income. So, in other words, your income that you receive from other sources that is taxable, your profit is also added to that, and that lump sum is taxed. Then, advantages of a sole trader. Now, the good thing about a sole trader is that it requires very little capital to start. And it's very quick and easy to make decisions because you are the only one that makes the decisions. So you don't have to go and follow up on other channels in order to make sure that the decisions are correct and that you can implement change or something. It's only you that make those decisions, which makes it very easy and quick to implement new decisions. Then there's no legal processes or requirements for a sole trader. You can easily adapt to the needs of a client or customer because it's only you. The assets of the business belongs to the owner personally. So everything you buy for your business, your assets, vehicles, equipment, those things belongs to you. A sole trader can close contracts and trade in his own name, which is beneficial. So if you are good with what you do, people know your name. So it's very easy to then also get customers. The owner takes all the profits. There is personal encouragement and personal contact between you and your customers. So they know you. So therefore you can sell to more customers. It's easier to get customers. Sole traders are generally closer to their customers and offer a more personalized approach and improved customer service, which is good for your business. Now we're going to look at the disadvantages of a sole trader. It is not always possible to pay high salaries. Unlimited liability, which means that the owner is personally liable for the debts and the losses suffered by the business. His business doesn't carry that risk. You yourself carry that risk. So if you go bankrupt, they don't just take the assets of the company or the business, they take your personal assets as well. Growth of the business can be restricted due to lack of capital. It's very difficult as one person to grow a business in terms of capital. Whereas if there's more than one person, it's easy because then you don't just have your capital, you have someone else's capital as well that contributes. The owner is responsible for providing all the capital needed, which may be difficult to raise a big amount. It's the same as the third point. If the owner does not have enough knowledge or experience, the business may fail because he's the only one responsible. A sole trader lacks continuity, especially in the event of death or illness. So if you are the only owner and something happens to you, the business cannot continue. Difficult to attract highly skilled and knowledgeable employees because they would rather work for larger salaries, for high salaries. And you know that one of the disadvantages of a sole trader is that it is not always possible to pay high salaries. Tax is calculated according to a progressive income system, which can be up to a maximum of 40%. So because your profit is added to your tax, your other taxable income, it puts you in a different tax bracket. And therefore you have to pay higher tax. Okay, so next we're going to look at the partnership. What are the characteristics or the advantages and the disadvantages of a partnership? First and foremost, we're going to look at the definition of a partnership. A partnership is an agreement between two or more people who combine their labor, their capital, and resources towards a common goal. It is very important that you note that it's two or more people. Do not write one because you cannot have a partnership with yourself. Partners share the responsibility of the business and they share the financial and management decisions of the business. So let us look at the characteristics of a partnership. There are no legal requirements in starting a partnership except the drawing up of a partnership agreement. And this partnership agreement can either be written or it can be an oral agreement, a verbal agreement. So partners combine their capital and they may also borrow capital from financial institutions, which you will see later will be an advantage of a partnership. Profit is also shared according to the partnership agreement. So usually the amount of capital you invest in the business determines your partnership percentage that you have. So, and then profit will also be shared according to that. Partners share responsibilities and they are all involved in the decision making. That you will see later is a disadvantage because it can sometimes hamper decision making because you have to have the go-ahead of all the partners before you implement change. Partners have unlimited liability. As you can remember, unlimited liability means that you share in the debt of the company. So you are jointly liable for the debts of the business in a partnership. So the business doesn't hold the risk, the partners hold the risk. There are no legal requirements regarding the name of the business, just as with a sole trader. There are no legal formalities to start, only a written partnership agreement is required. And then partnership has no legal personality and therefore has no continuity, just like the sole trader. So what they mean here is, let's say you are three partners in a partnership agreement and one of the partners decide they want to step out of the partnership agreement. Then the current partnership agreement, the document, or the verbal agreement basically falls away and it's not valid anymore, then you need to set up a new agreement. So and the same goes for when a new partner steps into the partnership, then a new partnership agreement needs to be set up and the old one gets dissolved. So that's what they mean with partnership has does not have continuity. Because every time a partner steps into the partnership, a new partner, or one of the current partners step out, or they pass away, or they're not part of the partnership anymore, then that partnership agreement dissolves and a new one needs to be set up. So therefore, partnership does not have continuity. The partnership does not pay income tax. Only the partners pays tax in their personal capacity. That means that the partnership company, the business that you have, the partnership agreement business, does not pay tax. But partner A, partner B, partner C, let's say if there's 3 partners, they have their own tax that they need to pay every month on their profit and on their taxable income, just as it is with a sole trader. Okay, so let's look at the advantages of a partnership. You can bring in extra partners at any time. All partners have a personal interest in the business. So the workload and the responsibility is shared between partners. Partners invest new capital into the business to finance expansion. So it's easier to grow financially. It is easy and inexpensive to establish, even with a written agreement. Partners share any profits and are therefore motivated to work hard. Partners share responsibilities for decision making and managing the business. But then there's also disadvantages. Partners might not all contribute equally. There can be a lack of capital and cash flow. Partners are jointly liable for the actions of the other partners. So if one partner screws up in the business, all the other partners are also held responsible. Partnership lacks continuity. If one partner dies or retires, the remaining partners need to draw up a new agreement. Partnership is not a separate legal entity and therefore partners are liable for the debts. So it is unlimited liability. Different personalities and options of partners can lead to conflict or disagreements. Each business partner is legally responsible for the joint liability of the partnership. A partnership has unlimited liability, which means that partners risk losing their personal possessions and assets if they get into financial trouble. Okay, now we're going to look at the closed corporation. And just so that you know, you cannot start a closed corporation anymore today. You can, if you started a closed corporation about 10 years ago, you can still continue as a closed corporation, but it will dissolve with time. Most people can turn their CC into private companies, or they can start a private company if they want to end their CC, but you cannot start a closed corporation anymore today. You can only continue as one if you started a closed corporation 10 years ago. So what is the definition and the characteristics of a closed corporation? It is a business that is owned by members. Very important, that word, members. And it can have between 1 to 10 members. The characteristics can have a minimum of 1 and a maximum of 10 members who share a common goal. The name must end with CC. Members of the CC both own and control the business. Profits are shared in proportion to the members' interest in the CC. So a CC has its own legal personality and therefore has unlimited continuity, which you will later see is an advantage. Each member makes a contribution of some assets or services towards the corporation, which is also a benefit. The word close means that all members are involved and participate in its management. Members have unlimited liability. except where the CC has had more than 10 members for 6 months or longer. Members of the CC are paid according to the percentage interest owned by each. So what are the advantages of a CC? A CC is a legal entity and has continuity of existence. So if one of the main members pass away, the CC can still continue. A closed corporation is easy to establish and to operate because there are fewer legal requirements than companies. A closed corporation is not required to hold annual general meetings, AGMs. Meetings are not compulsory and can be held on an ad hoc basis. Members have limited liability. And if you can remember, limited liability means that if the company is in a financial trouble and there's debt that cannot be paid off, then the company's assets will be taken, not your own assets. What are the disadvantages of a CC? Limited growth and expansion, since a CC cannot have more than 10 members. A member of a CC can be held personally liable for the losses of CC if the member acts is incompetent. Audited financial statements may be required when applying for a loan for your company. All members must agree to dispose of a member's interest. This could make it difficult for members to leave the CC. Every member acts as an agent of the CC, and the CC is bound by the member's actions. It is not possible to sell a CC to a company because companies cannot be converted into CCs. But, as you know, because a CC cannot form a CC, you can later decide to convert your CC into a private company, but not the other way around. A CC is taxed on its income, and standard tax of companies, STC, based on members' dividends. So therefore, it's double taxation, and that is actually a disadvantage of a CC. So you are taxed on your income, and the company is taxed. What are the differences between a sole trader and a partnership? Now, remember, we are going to look at the differences. It will be asked in the test or in the exam, and specifically, if they ask a sole trader, they will ask a sole trader the difference between a sole trader and a partnership. So let us look at the sole trader. Sole trader is a business that is owned and managed by one person, whereas a partnership is between two or more people or partners who combine labor, capital, and resources towards a common goal. A sole trader is quick and easy decisions can be made because it's by one person that makes a decision, whereas partnership may take a little bit longer because they may disagree on important business decisions. In a sole trader, if the owner does not have enough knowledge, the business may fail. Whereas in a partnership, all the partners put their knowledge together and then they can make the business more successful. And this is your lesson 1 on forms of ownership. And the next lesson, we will discuss a private company, a public company, a non-profit organization, personal liability companies, state-owned companies, and then we will also discuss cooperatives. Thank you.